Okay, good morning, traders. Hope we're all doing well on this fine Tuesday morning. It's absolutely fantastic to see some regulars here. For those new to these webinars, the rather odd-looking chap talking to you right now goes by the name of Aaron Hill, and I'm one of the market analysts here at FP Markets. I sincerely thank you all for taking the time to be here today, and I hope I can provide enough content to have you walking away from this presentation a more, shall we say, knowledgeable trader. I see in the chat box it's rather empty right now, so I'm assuming audio works and visually we can all see the welcome slide. Any technical issues, as usual, please let us know, and support will try and get you up and running. I'm just going to check the chat box. I can hear you all good. Thank you, guys. Thank you for letting me know. Okay, so for this, just a friendly heads up, a recording of this webinar can be accessed on either the FP Markets website or on FPM's YouTube channel. As an addition, our support team will send out an email following the conclusion of this presentation with instructions on how to view the recording. So for this presentation, the spotlight is firmly focused on Japanese candlestick analysis, a topic widely followed in the technical analysis community. Look, before we kick things off, let me just quickly run through the disclaimer on screen, and we're then free to deep dive into the world of candlestick studies. Right, the disclaimer on screen shows that information presented in this presentation is intended for general advice only, and none of it should be relied upon as personal investment advice. As you can see, FP Markets do not take into account your investment objectives, financial situation, or particular needs. As I've said in many presentations, this disclaimer is ultimately here to say what we talk about in this webinar should not be considered as investment advice, and you should always do your own due diligence with everything in trading and investing. Okay, let's brush that aside. So first up, we'll take aim at Japanese candlestick structure, which falls firmly under the umbrella of technical analysis. Guys, it goes without saying that before a trader considers candlestick patterns, he or she must understand the basic framework of a candlestick. For those interested, I do personally recommend a book called Japanese Candlestick Charting Techniques, written by a gentleman who goes by the name of Steve Neeson. Here he touches on the long and colourful history of candlestick trading and runs through each candlestick pattern in detail. Actually, let me just throw a link for this book in the chat box, because I believe it can benefit a lot of traders interested in candlestick charts. Just give me a second, guys. I think this is... Okay. Guys, just to be clear, I have no affiliation with Neeson's products. It's just a book. It's just a book I found useful when I read it, and I thought it may benefit those looking to, further their understanding. Right. So next on the menu, we'll nosedive into what I believe are three candlestick patterns that traders must know. I think, although more than, I think 30 recognized candlestick patterns exist, each boasting weird and wonderful symbolic names, these three candlestick patterns are superior in my humble opinion, but please feel free to question my choices and also highlight any candlestick patterns you use or follow in your trading. So with at least three candlestick patterns under our belt, we'll then focus on how to incorporate these patterns in our analysis. I will say that, you know, right now I will say that any candlestick pattern traded in isolation is not something I would ever recommend. You know, some traders may have had success with this approach. Yeah, I've not met anyone who has shown consistency through candlestick trading in isolation. And to round off the webinar, I'll open up the floor to any questions. This is the point I really encourage newer traders to step forward. Guys, I know what it feels like to be learning how to trade in the early stages. You're literally bombarded with, you know, a myriad of topics, each requiring dedicated learning, which can be tough. So, you know, for me, there are no silly questions. So as I said, feel free to step forward at this point. Okay, so look, I'm assuming most of us here are familiar with what a candlestick chart is. If not, please go ahead and watch previous webinars by me and my colleagues regarding chart type structure. We also have a collection of articles available on the FP Markets website regarding chart types. So please feel free to visit our dedicated Traders Hub. Right, you know, in a nutshell, a chart is simply a place to offer a visual representation of a securities price over a set period of time. As this presentation is focused on candlestick patterns, the slide you see now is a candlestick chart, which I believe I took from the hourly time frame. Right, now important characteristics to be mindful of in terms of candlestick structure are the real body, the open, the close, as well as high and low points. The candlestick's real body, as shown on the slide, signifies the range or distance between the open and close over a specific time period. So when the open and close are widely separated, this demonstrates strong momentum occurred during this time period. And this can be in either direction. So we have bullish sentiment and bearish sentiment. The appeal of using candlesticks to display data is not only is the real body more visually striking than, say, the bar chart, it's also color coordinated. As you can see here, I went with grey for bullish movement, which means a price rise, and a black color for to demonstrate bearish activity, you know, downward movement. Okay, so for the opening price, the candle open, this defines the beginning of a candle's life. The open could be, you know, on an hourly basis or on a minute-by-minute setting. This will obviously depend on the time frame selected. So look, an hourly chart would see a fresh candle open each and every hour, and a minute chart would clearly have a 1 minute candle open each minute. And onto the candle close. This outlines the completion of a candle. This again is dependent on the time frame selected. For example, the hourly time frame will see candles close, essentially settle each and every hour. The highest price, also known as excuse me, also known as either the high or upper shadow, and sometimes even referred to as the candle wick. And this is identified through a candle's high. It demonstrates the highest level the candle achieved over its lifespan. Oh, what's going on? Okay, the low and now the lowest price, or low, or even sometimes called the candle's lower shadow or even tail, represents a candle's low point. Signifying the lowest price the candle achieved whilst active. Look, guys, before I move on, are there any questions on this basic candlestick structure? Okay. Just looking at the questions, guys. Okay, we have a few comments about the audio. Guys, just quickly confirm you can hear me loud and clear. Is that the case? Or is my volume down? Or yeah, okay. All right, thanks, guys. Thank you. Also, we have a question. Can I ask, trend lines and Fibo are your best? Oh, well, I can't see one second. The questions are coming in. Can I ask, trend lines and Fibo are your best working to bodies or wicks? That's a really good question, Megan. For me personally, if I'm using trend lines or fibs, I always look for the candle, the upper shadows and lower shadows. But I know with trend lines, you can also use the candle bodies as well as the wicks or tails. Okay, so is there any questions on the basic candlestick structure that I've highlighted here? If not, I will quickly move on. Okay. Okay, look. So while prepping for this webinar, I struggled to decide which candlestick pattern to begin with, but given I used the hammer and shooting star candle formations in my own analysis, I thought it would be an ideal starting point. So now, to avoid confusion, hammer and shooting star candles are also commonly called bullish and bearish pin bars or Pinocchio bars. This is a term, I believe, coined by Martin Pring in his book Technical Analysis Explained. I do not have a link for this available, but I'm sure a quick Google search would help. Right, look, I think the main gist of the Pinocchio bar psychologically is due to the fictional wooden puppet, Pinocchio, who had a frequent tendency to lie, as does the pin bar in terms of market direction, that is. This should become clear why when we move on to how to incorporate these patterns in our trading methods. So a hammer pattern, or as some of you will refer to as a bullish pin bar, boasts an interesting construction. The candle has a real body located at the upper edge of its range. For these patterns to be considered valid, I guess you could say valid constructions, the lower shadow must be at least 2 to 3 times the size of the real body. The upper shadow also must be small. When I say upper shadow, I'm talking about the wick that normally appears here should be small to non-existent. Another point to be mindful of is the candle body's, the real body color. In my opinion, it's irrelevant, but some people may want to see a bullish close form here. And really, guys, aside from this, that's all to it, really, with respect to its framework. So look, the shooting star pattern, we'll be looking at a similar construction to the hammer pattern, except with the shooting star, it's obviously turned on its head, so to speak. So instead of having a real body located at the upper range of the candle, the shooting star has the real body located at the lower range. We will also be looking at the upper shadow to form at least 2 to 3 times the size of the real body. Look, it's important to note that both the hammer and shooting star candlestick patterns are considered reversal patterns, which essentially means it's a formation that helps forecast a change in direction or a change in trend. Therefore, it's critical to note that preceding the formation of either a hammer or a shooting star, a trend must be present, or a lengthy retracement or pullback. Excuse me, guys, just 1 second. Okay, let me just check if there's any questions regarding this. Okay, we have one question. The wick is the same color as the body. David, no, normally it's not, but you can set it up that way. I think most charting platforms do allow you to color coordinate your candle patterns, but generally no. I always keep my lower shadows and upper shadows painted in black, and either blue for a bullish color or green for a bullish color and red for a bearish color. Assume we have another question. Assume that the hammer is bullish. Yes, John, it is. A hammer pattern is a bullish signal, and a shooting star is a bearish signal. But guys, there are other patterns that are actually of similar construction. We also have the hanging man, right? And we also have the inverted hammer, which I'm not going to go into right now, because I might just confuse people. So let me just check if there's any. To identify reversals, what's the best time frame? Megan, I'll go into that when we move on to the next section regarding where to time frames and reversals. Another question from David: if it presents as a contrast color, I'm not sure what you mean, David. Can you possibly explain just a little bit more regarding the color, and then I'll answer your question. No worries. Okay, moving on to the next slide. So next on the scale, we have what's known as a bullish or a bullish engulfing pattern, which, unlike shooting star or hammer candles, are shaped by way of two candles. Again, though, guys, bullish or bearish engulfing patterns are considered reversal signals. So these formations tell traders that buyers or sellers, dependent on which direction the pattern formed, are in full control of the market following a previous bullish or bearish run. It's also, okay, this might confuse a few people, but it's also important to be clear that a textbook engulfing pattern, candle pattern, is a configuration in which the second body, the second real body, engulfs that of the initial real body, and should, like the hammer and shooting star candlestick patterns, precede trending movement. So this is a bullish engulfing pattern, and the body, the second real body, must engulf the first initial bearish real body. Look, so this is where the confusion normally comes in. Now, the engulfing pattern is similar to what's known as an outside reversal bar. Let me just click this on. So an outside, but this does not require the range, so high or low, to be engulfed, just the open and close. So with engulfing candles, the real bodies are what's important. This is why, for those who follow my analysis on a regular basis, you may note that I tend to highlight mainly outside reversal patterns rather than what you would say textbook engulfing patterns. As with the FX market, which is all I focus on, is essentially a 24-hour market, and gaps are rare except on the weekends and maybe with large news releases. So look, textbook engulfing patterns are more common in, say, equity markets with exchange opening and closing times, where many more trading gaps are present, which can help form textbook engulfing patterns. For me, in my experience, the color of the candle bodies do matter with bullish and bearish engulfing candles. For both bullish and bearish patterns also, the signal is said to be much stronger if the initial body is small and the subsequent engulfing body is large. So for a bullish engulfing pattern, we would, in the case of the color coordination shown on the slide, require a red bearish initial real body, followed by a subsequent green real bullish body. So while look, there is a difference. There is a difference between engulfing candles and outside formations, though ultimately I always look for both an engulfing pattern and an outside pattern blend. What I mean by this is, the range, the highs and lows engulf the previous range, and also the second candle, the real body, the second candle's real body also engulfs the initial candle's real body. So we have a blend of engulfing patterns and outside reversal formations. Hope this is making sense, guys, but don't worry. I will answer any questions at the end when we drive over to the charts. Now look, the flip side of a bullish engulfing pattern, of course, is a bearish engulfing pattern. This is simply the a mirror image of the bullish version. As you can see, the initial bearish, candle body represents a small bullish close, with the next candle forming a larger, more prominent bearish candle real body, one that engulfs the previous candle's real body. As I've already said, bullish and bearish candle patterns are reversal signals, so a trend or a lengthy move must precede the pattern's formation for it to be considered valid. Okay, look, and finally, we're on to an interesting candlestick pattern that goes by the name of Doji. Actually, guys, let me just spin over, see if I've got any questions regarding this. We have a question: should I be able to see other people's questions in the chat window? I'm not actually sure. I don't think you can. I'm not sure about that. We have one more question. Don't you reckon that the confirmation is the third candle? Thanks, Alex. That's a good point. We're going to touch on that when we incorporate that in the trading strategies. That's very shortly, mate. Okay. This is basically, I'm just trying to highlight the structure of the candles at the moment, and then I'll move on to the entry and exits and things like that. Thanks, Alex. So look, as I said, finally we're on to the Doji candlestick patterns, and this for me is quite an interesting pattern. Standing alone or incorporated within 2 or even 3 candlestick configurations. Think, the Harami cross or patterns, or Doji stars in morning star and evening star candlestick chart patterns. The Doji represents a period whereby the open and close are pretty much equal. All right, there was very little trading from the open to close. A Doji ultimately demonstrates indecision, a point where the market is in, shall we say, equilibrium between supply and demand. This can be viewed so a Doji can be viewed as a possible continuation pattern. The market is simply taking a breather, right? Or a potential point of exhaustion in trending markets, so an uptrend or a downtrend. The Doji is a reasonably colorful pattern, appointed different titles depending on where the open and closing prices fall and the position of the Doji formation on the chart. So as you can see from the slide, what you would call a traditional Doji candlestick formation can be seen at the bottom. Note that a Doji formation that precedes an up move is typically called a northern Doji, while the one that forms at the lower after a down move is termed a southern Doji. But this is we rarely use this. Analysts rarely use this term. It's just I want you to be aware that textbook style would label this as southern Doji and northern Doji. As you can see with the traditional Doji candlestick formation, the lower and upper shadows are relatively I say equal in size, and the real body of the candle is almost non-existent. So a variation of the traditional Doji, of course, is a long-legged Doji formation, presented in the form of long upper and lower shadows. This is typically a formation that you will see when the market is, shall we say, very, very confused. I've seen this form following the release of important risk events, for example, news releases. And another popular Doji variation is what's known as the Dragonfly Doji, a candlestick pattern established by an open and close positioned at at or near the high of the candle. Its long lower shadow depicts a point where, sellers initially had the upper hand, but ran out of steam and handed the baton over to buyers. Quite simply, the pattern is similar to a hammer. Sorry, guys. The pattern is similar to a hammer candle formation, though effectively should be void of a real body. If you remember on the hammer the pattern, we had a real body here that was equal, and a lower shadow 2 to 3 times the size of the real body. The bearish counterpart to the Dragonfly Doji is what's known as a gravestone Doji, molded through an open and close, formed at the lower end of the candle's range. Bearing a resemblance to a shooting star candle pattern, it can help. This pattern can help warn of an uptrend running out of steam, so a possible overbought market. Okay, guys, look, we're going to move on to the next section. This is applying candlestick patterns in your trading. Look, I'm a firm believer that there's no right or wrong here. The only theory I would be a little bit concerned about is trading candlestick patterns in isolation, as I noted at the beginning of this presentation. Let me just check if there's any questions before I move on to this part. Okay, we have one question. Sorry, guys, just give me a second. Do these patterns need to print on a zone for them to be effective? I hope this will, the next session will answer that question. So for me personally, a candlestick pattern should format technical structure in line with other technical confluence for it to be valid. I've never met anyone that's successfully traded candlestick patterns in isolation. Ivan, yes, any stats on the frequency of these patterns? There's actually a really cool site. I can't remember the name of it, but if you send me an email, I'll get the stats over to you. So we have a question: any stats on the frequency of these candlestick patterns? There was a huge study done on candlestick patterns, I believe. I could be wrong, but if you send me over an email, Ivan, I'll try and get that link over to you. It was quite an extensive study on the patterns. I think the guy goes by the surname of Bukwak. I can't pronounce it, so I'm going to butcher the name for sure. Bukwalski, I think, and he did a real extensive research on these patterns. So if you ping me over an email, Ivan, I'll happily send you. I'll find that link, find the site, and I'll ping the link over to you. No worries. So just continue. So look, as I said, I'm a firm believer that there's no right or wrong in this situation. I would personally, though, avoid trading candlestick patterns in isolation. So look, a common way of incorporating candlestick analysis is by employing them as confirmation of support and resistance. This could be traditional horizontal support and resistance levels, trend line support and resistances, or even supply and demand zones. For newer traders here, unaware of what support and resistance or trend lines are, please feel free to check out my beginner's webinar on support and resistance on the FPM website or through our YouTube channel. Now, on the slide, you will note we have a euro-dollar H4 chart with support and resistance applied. The lower support, just sort this out, the lower support was simply a previous high that was breached and subsequently retested as support. The interesting part, however, was the retest was formed by way of a hammer I'm trying to find my cursor. Was formed by a hammer candlestick pattern. As you can see, price spiked through the support, likely trapping breakout sellers, effectively forming what's known as a bear trap. Although hammer candlestick pattern forming at support, which is a bullish signal, increases the odds of a price advance. It will never guarantee that support is going to hold. It does, however, as I said, help add weight to the possibility of an advance unfolding. As I cherry picked these, in this case it did. We had a lovely, a clear high that was broken and retested as support, followed by a hammer candlestick formation. So with the pair breaking higher, this highlighted the, oh, sorry guys, just change the slide back. Excuse me guys, just give me a second. So where was I? Okay, as we broke through the support and resistance, a larger support and resistance area, we did have an initial test, which in my opinion did not form anything of interest in terms of candlestick formations. However, on the second retest, we did form another hammer candlestick pattern, which led to fresh highs. For those who look at multiple time frames, spinning down to the H1 time frame, as this is the H4, you can spin down to the H1 time frame, and you'll note that there was actually another H1 hammer pattern present in this zone. This could help with controlling entry and risk. So look, as for entry, traders have a number of options with the hammer and shooting star patterns, depending on their risk appetite. Most conservative, oh God, I'm so sorry about this, guys. I keep clicking that. So look, most conservative in terms of entry that I know of is to wait for the next candle to form following the formation of in this case, hammer candle pattern. The trader then often proceeds to enter on the next candle's open with a protective stop loss orders plotted under either the hammer's lower shadow or beneath the support and resistance area, which would be around here. Another method is to set a buy stop order 2 to 3 pips above a hammer's upper shadow. And then we either have if the order is triggered, we then have the option of either again placing stops below the lower shadow or below the structure that the candlestick pattern formed from. There's one other method I know of which is a little more aggressive, is to enter on a retracement. So the candlestick formation forms, and then the trader sets a buy limit order halfway through, so 50% of the range of the hammer pattern. So as you can imagine here, if we'd have set a limit order to buy here, price would not, we would have missed out on the trade, right? Because price just took off literally as soon as shortly after the hammer candle pattern formed. So, but frequently you do see a mild spike lower, and this fills these limit orders here. What this does is lowers the distance from your entry execution to your stop loss. So essentially, if we imagine if price spiked lower here, triggered your order here, your buy limit order with your stop here, the risk to reward on this trade would have been, unbelievable. It would have really been quite impressive. But as I said, this does open up the possibility of missing quite a few good trades. So look, guys, just to help round things off, I thought now may be a good opportunity to spin things over to the charts and pinpoint some interesting candlestick formations that formed at or very near technical structure. Let me just check any questions before I do that. 1 second, guys. I'm just Resistance can transfer. So we have a question. Resistance can transfer into resistance. David, do you mean resistance can transfer into support? If you do, yes, support and resistance level can go on for years. It can become support, and then if broken, it becomes, yeah, David, yeah. So look, if you have a support resistance, look, we can take this example on the slide right now. So we have some, imagine this is a form of support here. I know we had a small pullback here, but a form of support here. So we break lower, and then we have resistance form here, and again here. And then we break up, and then support forms here. Look, for support and resistance levels, David, I would never ever recommend drawing a defined level like I've done here. You should always aim for an area to work with, in my opinion. So look for a support and resistance area. Yeah, so look, there's another question from Daniel. Will the recording be on the platform? Platform, do you mean the FP Markets website, Daniel? If so, yes, and it will also be on the YouTube, on FP Markets YouTube. Yes, Daniel, yeah, it will be. It will be on the FP Markets website under, I believe, resources. So yeah, please go ahead, please feel free to go ahead and watch those recordings. One more question we have, taking the first entry on this chart, would your TP, where would your TP have been set? I'm assuming you mean this, which trade are you talking about, Pablo? Are you talking about this trade or this trade? I'll assume we go for this trade here. So if I was entering here, logically you would be first arrow, okay, this one here. So obviously if you're entering here and you know there's support and resistance above here, personally, this is only my personal opinion, guys, as well, I would not be taking profit at this area. I would be looking to possibly reduce risk. So we enter here and place our stop. Just hypothetically, we place our stop here. My initial plan would be to reduce risk to break even at this point, because we know it's been a level of support and resistance in the past. On a break above here, then I would consider moving my stop into profitable territory, and then looking for this Quasimodo resistance left shallow here, and then the other one up here. But mainly I would be looking at here, and I think we did get a reaction off that area from that point. So yes, I would be looking to reduce risk to break even at this point, and then looking upon breaking this area, I would be looking at the Quasimodo resistance left shoulder, pinging that across the chart and looking for a reaction to form there. As you can see, upside momentum did slow at that point. So at this point, buyers are likely lacking steam. So yeah, it would have been a good place to consider taking partial profits or even full profits, depending on your own individual trading strategy. Yes, David. Okay, no worries. Yeah, next time, can you have a larger chart? Give us an easier view. Yeah, sorry about that. I thought this would be clear enough. No worries. I'll do that in the next webinar. We have another question. Support and resistance are areas. How do you define? For example, using average body or wicks. So for me, I use as you can see, I use the bodies, the candle bodies and the wicks. So look, you're looking to form a range, right? You're looking to form an area of, so look, let me spin over to the live charts and we can look at these in more detail. Just give me a second, guys. Okay, I assume you can all see the euro-dollar time frames charts. Ooh, let me just see. Yeah, okay, I believe you can all see this. Okay, look, so there was a question about support and resistance. So look, I'm just going to try and find a support and resistance area that I've used. So the monthly time frame would be ideal. So I always look for areas that have, so look, this was an initial demand area, right? So we had a nice push higher, reaction, reaction, near reaction, break. Reaction as a resistance, so a supply you could say here, because it was a previous demand. Then we broke up. We had a small retest and we broke up. broke down, another retest. So this is an area of clear importance. So I look for to form, quite simply, just to form an area that price has broke. So that would include, yes, that would include the wicks and the bodies. Sorry, the wicks, the upper shadows and lower shadows, and candle bodies as well, to form an area. Now, do we have one more? Can I explain Quasimodo resistance and how effective? Look, the Quasimodo resistance, I'm going off candlestick structure here a bit, but look, the Quasimodo resistance for me is simply a fake out. There's a lot of different terms for it, up and under, I believe, or something like that, up and under version. But I've used Quasimodo resistance for years now, and I believe they're one of the most effective ways of finding support and resistance, particularly when they're broken. That may not. So when they're broken and so for instance, if we get a strong break up here and we get a retest, they're very, very effective in holding price normally, especially if they converge with other technical confluence like a candlestick configuration. But yes, a Quasimodo resistance is simply a left shoulder, a mild downward movement followed by a fake out to higher levels, and then followed by a subsequent move to lower levels. No, I don't, Daniel. It's not head and shoulders. The head and shoulders would require a right shoulder here, wouldn't it? So we'd have a left shoulder, head, and a right shoulder forming here. So the Quasimodo resistance is different in that sense. So one from Megan: how do you split your chart into 4 zones on TradingView? So look, if you just go up to this area here, select chart layout, you have all the chart layouts here. Okay, so look, if you want an individual chart, you set this, use point 1, 2 charts. Okay, cool. So back onto candlestick studies. Right, so the daily chart of let me just spin this chart into a full version. Look, real life trading is different from the slides I've shown. It can differ, of course. There's never a perfect setup, in my opinion. So look, the daily chart shows a clear cut shooting star candle variation here, which pierced highs, but which pierced these highs here, but failed to find acceptance higher up. And this was the formation that helped form this Quasimodo resistance, labeled here. It's 2169. This was clearly, in terms of candlestick structure, this was clearly an ideal time to begin looking to short this market, given the stops likely taken from the above highs. Now, when I'm talking about stops, I'm talking about buy stops in terms of, so we have, so above levels, we have breakout sellers, right? We have breakout sellers with their buy stops placed above here. And that this effectively forms a bull trap. So a bull trap is trapping the bulls, right? So so we ping up, we trigger these buy stops in. Brilliant. Breakout buyers think they're onto a good run, and then bang, it pulls right back to the open, to the lower edge of the candlestick, giving us, or giving the larger traders, possible liquidity to sell into, because buy stops. So when we sell, we need orders to buy into, right? So the buy stops triggered here, larger players sell into them. Okay, so this would have been an ideal, in my opinion, an ideal area to be looking to sell this market. There was a H1 hammer pattern also on the euro dollar, which formed, right, let me just zoom in so you guys can see it. Okay, this is, I would say this is more of a dragonfly doji. If you look, zoom right in, the candle body and open and close, the candle body open and close is relatively tight, right? So, but look, let's just stick with the hammer candle because it has got a body there. So we have a hammer candle that formed off the key figure 120. Now, as you guys probably know, they're around big figures like 120. There are often a large number of stop orders. There are a large number of stop orders. So again, price would spin through these orders, and with these areas, we get traders looking to buy and breakout sellers looking to sell. So a whipsaw through this area would likely trip sell stops, again forming what's known as a bear trap. We have a few questions. So you use daily charts? Yes, David. I always use daily charts. Always use daily charts. Monthly, daily, H4 and H1 charts. Alex, sorry, you meant there to short. Oh, I can't see that question. You meant there to short the stock. No, that's a currency pair, David. Did you mean the daily time frame here? If you're talking about this, Alex, if you're talking about this area here, now I would have at that time I would have been looking. Traders would have likely been looking to sell this market, given this, given the context around. So look, I wouldn't be trading this in isolation, would I? I would be looking at the context of the picture on the chart. So this broke through a number of key highs. So a resistance, just think of it as a resistance. Knowing that, and we close back below the area, we've got a potential shorting opportunity on the cards, right? Okay, so look, I have one textbook bullish engulfing pattern used on the daily chart. So David, then reduce time. So you use daily charts. Okay, look. So on the dollar yen monthly time frame, let me just spin this to the larger screen. So we have this is what I would call a textbook engulfing bullish engulfing pattern. As you can see, zoom right in, the candle body. So this is not only a textbook bullish engulfing pattern, this is also a outside reversal, right? This is the blend that I always look for, but it's very difficult to get in the FX market because of the 24-hour trading. But look, we do have it on this chart, monthly time frame, because as the weeklies, as the weeks, we often get weekend gaps, right? So look, we opened here, opened below the candle body's close, and we closed above the candle bodies, the previous candle bodies open, and also engulfed the entire range. So the entire range being the high and low, engulfing the previous low and previous high. This did not form at any real structure, but did form ahead of support. So yeah, it clearly triggered a healthy bullish up move. Also, just quickly, I'm going to spin things over to the US dollar index. Now, for any guys that are not aware of what the US dollar index is, it's a fantastic way of determining the value of the US dollar against other currencies. So the US dollar index contains 6 component currencies from the euro, the Japanese yen, the British pound, the Canadian dollar, the Swedish krona, and Swiss franc. Now, just be aware that the euro has the biggest weighting in the index of around 58%. I think technically it's 57.8% or something like that. But it has the biggest weighting, and this can be used as for correlation on the euro dollar. So if we're in an area of resistance on the US dollar index, normally we can expect the euro dollar to trade inversely. Okay, so back onto the Dixie charts, we had it was here I wanted to show you. This is the bearish outside reversal, I think. Yes, bearish outside reversal. So we had a clear pullback low here, spun across, and price just missed the area. This is just an example to show you of what a bearish outside reversal would look like on the daily chart. So we have a high above the previous candle's high and a low below the previous candle's low. As you may well note on this chart, on this formation here, the candle body does not engulf the previous candle body, hence why I label this as a bearish outside reversal rather than the textbook bearish engulfing pattern. Okay, let me just see if there's any questions. Give me a second, guys. So there's a question from David. When setting support and resistance, you use a minimum of 3 points. No, no, David, I use a minimum of how many points is required to form a logical support and resistance area. Let me just try and find one for you on the charts. Here we go. This is a nice one. So here we started off with a point of resistance here. You can see price clearly held lower at this point. We broke up, and then we got a number of reactions here. So we know at this point, all right, the market's interested in this area, and especially after this reaction here, a reasonably meaty pullback, I would say. Come back down, and again we get more reactions. All right, not to the pip, but they are reactions nonetheless. Then we come back up, we get another reaction here. But there's clearly, it's very hard to deny that the market has interest in this area, right? So as we know that, we can spin this, you know, we can extend it into the future. So no, there's not, I don't look at a set number of points really. I just look at the chart and let the chart tell me where to apply the support and resistance area. In this case, I used the candle bodies as I wanted to capture more of the range, candle bodies here, and I used the, I believe I should have used the wicks, the lower shadows around this point here to extend, and just to see how price reacted. As you see, we're now in a range on the Aussie dollar using this area as demand, and a 7,800 Quasimodo resistance, as you can see, is capping upside. I hope that answers your question, David. Let me just see if there's any more questions, guys. Just give me a second, please. As a day trader, I do need to start my analysis. As a day trader, do I need to start my analysis from monthly or the weekly chart to get primary trend? So that's a good question. So primary trend is the largest overall trend, right? So for me personally, I would always look at the weekly time frame for the primary trend. But if you're a day trader, it depends on what time frames you trade. So if you're trading the M15 time frame, the weekly time frame is not really something I would look at. So for instance, if you're trading the weekly time frame and you're trend trading the weekly, the M15 time frame, I would be looking at the H1 and H4 time frames, maybe even the daily time frame for my primary trend, maybe. But H4 would be my primary trend for me. Because can you imagine if you're going out too far to the weekly time frame, it's not going to make much difference on the M15, for example. So so yeah, I hope that answers the question. So no, I would not. If you're a day trader, depending on if you're trading, depending on the time frames you trade, to be honest. Another question from when you see engulfing pattern, do you consider any other indicators to confirm the direction buy or sell? Yes, Elvis, yes I do. As I said, I would be looking for technical confluence from either a trend line, support or resistance, Quasimodo resistance. Let me see if I've got an example here. I think there is. Right. Okay, no I don't. But look, this is what I would say is a half-hearted shooting star pattern here. So look, we know we're coming off Quasimodo resistance, right, Elvis? We're coming off Quasimodo resistance. We've reacted. We've formed a rather meaty, upper shadow, and formed a half-hearted shooting star pattern. Now, with that, we know that sellers are interested. So this is how I would help confirm the pattern or the direction, as you've asked. So this would be a sell, wouldn't it, really? If you're coming off resistance and you formed a notable candlestick pattern, this would be what I would consider an ideal area to be looking to short. But look, guys, you can look at other confirmation tools. You can look at Fibonacci. You can look at, as I said, trend line resistance. You can look at the RSI, the MACD. There's so many other ways. You've got to find your own strategy and then backtest that to confirm its validity. Okay, look, another question. When you see an engulfing pattern, do you consider any other areas? I think I just answered that one. To confirm the direction of price, that's the same question. I hope I answered your question there, Elvis. Okay, one more question here. I always look at the time frame above or two above for the trend. Yeah, that's perfect. Use the KYI, I think that's your name. Yeah, that's what I would be looking for. So for instance, if you're trading the H1 time frame, I would be looking at the H4 and daily time frames for trend direction. Yeah, I hope that answers the question. So a question from Pablo: would you apply this technical patterns to scalping currency pairs on M5 charts? I don't see why not. I've never done it personally. I do not see why not, but always I would always look for areas of technical confluence, and the candlestick structure is technical. It helps form technical confluence, right? So as I said, we have a Quasimodo resistance here. We have just a half-hearted shooting star candle pattern. Now imagine if you had a Fibonacci cluster here, so a resistance area of Fibonacci levels, along with an RSI, bearish divergence signal. This would be an ideal area to consider shorting on the M5 chart. But again, I would always consider the higher time frames as well. Yeah, I would always consider the higher time frames. But if you're trading the M5 charts, I would be looking at the M15, M30, and H1. Maybe the H4, maybe, but it would mainly be the M15 and the H1. Oh, okay, guys. I think that's all the questions covered. Let me just spin things back to this. So look, guys, are there any other questions that I've not covered in this? I'm just trying to check just really quickly. There's no other questions. I don't see any other questions coming through. So look, guys, I'll look to end it here then. I sincerely hope some of the newer traders were able to walk away from this presentation more knowledgeable. Okay, we have another question coming through. 1 second, please. How do you draw the short horizontal line used to identify the short horizontal line used to? So look, please, how do you draw the short horizontal line used to identify the resistance? Was you talking about the Quasimodo resistance there? Let me just spin things right back to the chart just real quick. Are you referring to this? The Quasimodo resistance. So always look for the left shoulder. So look, a Quasimodo resistance or a Quasimodo support is simply a left shoulder, because it's been faked, right? We look for fake outs. So another Quasimodo resistance, I'm just trying to find one on the chart. Another one would be here, wouldn't it? So we'd spin it from this left shoulder here, because we've had a decent fake out and we're back up. Now price hasn't hit that area yet. We also have another one here, which reacted, another left shoulder, fake out, down, up, reaction, down. Okay. I will, if you guys are interested, I will look at creating a webinar dedicated to Quasimodo resistance and support. If you guys are interested, please let me know, and I'll happily go over this, because I see a lot of interest in this formation. Yeah, and it's, as I said, it's an ideal area of, it's an ideal way of locating support and resistance, and it's pretty much objective in my opinion as well. I mean, of course, you can pick the different left shoulders. Okay, so you wasn't talking about the Quasimodo resistance there. Okay, I mean the horizontal line on TradingView. I don't see any other horizontal lines above. Oh, you mean up here? I'm going to call you Bart, because I'm not sure I'll be able to pronounce your name. So you're talking about this area here. This is simply a horizontal line. That's it, nothing more. The trend line on the left. Oh, you're talking about that's a trend line support. I mean on the Quasimodo. Okay, yeah, I've just okay, the Quasimodo, as I just explained, is a left shoulder that's faked. Okay, I'm sorry, I'm not really understanding the question. If it's about the Quasimodo, I've just explained that this is simply a fake out. But look, guys, as I said, I'll try and create a webinar on this in the very near future. There was one Wow, sorry guys, I'm just looking at the questions. Okay, I think that's all the questions. Look, guys, if there are any specific topics, as I can see, I might have misunderstood a question here. Please feel free to send the suggestions to me at marketanalyst@fpmarkets.com. We've just pinged that in the chat box. Please feel free to send me any questions you're unsure of in this presentation, and I'll happily, me or the research team will happily get back to you. Also, look, guys, do make sure to register for the FP Markets Telegram channel. As always, the sign up tab can be found at the lower part of the, and we just pinged a link into the chat box. So yeah, just click on the link and you'll have instant updates available from our Telegram channel. So look, guys, on that note, I thank you very much for taking the time out of your day to attend this presentation. I really hope you took something from it. Have a great day, and look, I'll catch you again next week. Thank you very much, guys. Cheers.